think, first of all, congratulations to all of us. I don't think anybody's complaining when the market is reaching new highs. So enjoy it while it's there. And you rightly mentioned that at the aggregate level, earnings have not been as great, both for the Nifty 50 as well as for the broader markets of 500 stocks or so. So obviously, on one side you have earnings which are kind of decelerating, I would say, not going down, but the momentum is not as great as it was last couple of quarters. And that's primarily because the margin tailwind that we had for the last 2-3 quarters is no longer there. So I think it's back to normal margins, normalized commodity prices, and that's what we are seeing. But having said that, as you rightly mentioned, some of the pockets like financial services, especially within financial services, the banks and the NBFCs, they have underperformed, and rightly so, because we did see some margin pressure emerging. Credit growth has not been great, and RBI has been clamping down on the faster growing segments, which also happen to be the more lucrative segments in terms of margins, which is the unsecured loans, etc. So you had 2 or 3 kind of minor or mild headwinds, I would say. On the positive side, of course, the sector is as healthy as it has ever been in terms of NPAs, balance sheet cleanup, availability of capital. So I think all that is setting the base for a nice pickup as and when we see the financial conditions easing. And given the global situation where we do expect the Fed to start cutting rates as early as next month, I think the worst of the tightening is over. And in the next couple of quarters, we should see the financials, with the lenders basically, doing well. And as I think Rohit just mentioned a little while ago, within the financials, the other part has been doing well actually. The capital markets link, the wealth managers, the brokers, the exchanges, etc. That part has been doing well, So I think the market is still discerning. It is identifying pockets of growth and rewarding that and punishing the pockets where growth is slowing down. So I think they're still not in bubble territory, not in complete frenzy. But of course, it's always wise to be choosy and not go down the quality curve.
All right. Hi, very good afternoon, Mihir, and indeed great moves on the indices. But you just shared your take on the financials, but there's a lot of sector churning that is happening, and even Rohit was mentioning that it's the rotation that is keeping the indices in momentum. But for today, it's the IT and the pharma space that has hit its all-time high levels. But going ahead, which sector could be on the front lead, Mihir? Any take on that? Where do you still find opportunities?
So I think what we have tweaked in terms of our approach, I would say, is that it's trying to be more stock-specific than take a top-down sector call. 6 months ago, 3 months ago, or even 1 year ago, it was easy to take a top-down call on some of the sectors, like, say, defense and railways and the renewable space, because they were relatively still under-owned. And understood, so to say. But now I think they are pretty much mainstream, widely owned, and a lot of volumes happening. So obviously, even the retail investors are in the game for those segments. So they are no longer relatively undiscovered segments. So I think while we continue to like these segments like these, we are more choosy and not taking a big sector allocation call on this. We are going more bottom up now. I would say the pockets where I can see some good balance is, as we discussed, financials, especially the lenders, which have gone through a bit of a squeeze in the last few quarters, but things are looking up going forward. And typically, we have seen the market do tend to discount good news or bad news a little bit in advance.